Corporate finance practice problem using Excel. Stock purchase versus cash dividend. Get ready, it's time to take our chance with corporate finance. Here we are in our Excel worksheet. If you have access to the Excel worksheet, would like to follow along, note that we're in the practice tab as opposed to the example tab. The example tab, in essence, being an answer key. Information's on the left-hand side, populating that information into the blue area on the right-hand side, looking and contrasting a situation where the company's going to repurchase stocks versus using the money to then give the cash dividend. So we're going to say that the earnings, $5 million, the shares outstanding, $2 million, the price earnings ratio, $30, and the excess cash that we have then, the $5 million. The excess cash then is what we're going to think about using in order to either distribute in the form of the dividends or to repurchase some of the stock that is outstanding. So let's calculate our earnings per share then. So the earnings per share are going to be equal to the earnings. We're thinking net income, bottom line of the income statement with the earnings at the 5 millions. The shares outstanding at the 2 million, 2 million of the shares outstanding. We're then going to do the underline, font group, and underline, and then we're going to have the earnings per share. Earnings on a per share basis, otherwise known as earnings per share. Let's add some decimals to that number group. Couple decimals there. We're at the 2.5. Now we're going to look at the stock price. To calculate the stock price, we're going to be considering the price earnings ratio. So you might think about the price earnings ratio itself and then back into the price earnings ratio, comparing the price to the earnings. It's a pretty straightforward name. That's why you might, use your algebra to kind of back into then the price. So we're going to calculate it as if we already did the algebra. We're looking at the price calculation using the price earnings ratio, which is going to be then at the price earnings ratio of 30. And then we're going to be picking up the earnings per share. So the price compared to the earnings of the 2.5. Let's go ahead and underline that, font group, underline. And then we're going to get the stock price. And let's add a decimal here, going to the number group, adding a couple decimals. So we're at the 2.5, multiplying that out. We got the 30 times the 2.5. We're going to get this 75. That's even, but let's add a couple decimals anyways, just to be consistent here. Maybe this one should have some decimals too. So we're consistency. Consistency is important. Now we'll take a look at the dividend per share, assuming excess cash is used. So we're going to use that cash then to give out the dividends. And what would the dividends on a per share basis be? So we'll pick up the dividends. Then we're going to be issuing out the dividends of the amount from that excess cash that we're saying that we're going to distribute out in the form of dividends. We're going to compare that to the shares outstanding. So the shares outstanding, let's just pick that up here. Shares outstanding at the 2 million. These are outstanding shares because they're outstanding. So we're going to go home tab, font group, and underline it. That'll give us our dividends per share. Dividends on a per share basis. So we got the dividends going out in total, 5 million divided by the number of shares out there, 2 million. We're at the 3. Let's add a couple decimals. Number group, couple decimals. We're at the 2.5. So let's go on up and say, well, now let's consider a situation where the shares acquired if used the excess tax. So we're going to think about excess cash. We have the excess cash, and we're going to think about using it this time to acquire shares back from the market. So the company acquiring their own shares back. So we're going to have the excess cash. Let's just pick that up here. That's how much cash we can use to buy shares. That's what we have to buy stuff, which is our own shares here. And let's assume that we're going to have the same price down here, which is the stock price, to purchase them back. Now, if we purchase a large amount of shares, the price might be slightly higher than the market price at a given time, but I'm going to pick up the price there. We're going to go to the number group, add a couple decimals, font group, and underline. That's going to give us our shares acquired, acquired, and that is going to then be equal to the 5 million divided by the 75. Let's add a couple decimals, number group, couple decimals, and so there we have that. So that's going to be the shares that we could acquire if we were to use the cash for the purchase of our own shares. Now let's take a look at the earnings per share. Given that we're going to say, all right, the earnings, once again, bottom line of the income statement is going to be the 5 million. But now we have a change to the shares because we have acquired shares out. So we're going to say the shares before we had acquired some back were outstanding shares of the 2 million. We acquired back this 66 and so on. So we're going to subtract that out. We're going to take the 2 million minus the amount that we acquired back. It is a fraction, so notice there's going to be some rounding issues going on here. And then we're going to go font group and underline. That'll give us our earnings per share. So earnings per share, if we decide to acquire back, being the 5 million divided by the 1,933,333, that then gives us an earnings per share, an EPS, number group, a couple decimals of the 2.59, slightly different than the earnings per share if we were before we had at the 2.5. And let's look at the stock price then. Stock price, we're going to have the price earnings ratio, which we'll pick up over here, which we're assuming is constant. Price earnings ratio at the 30. And then we're going to have the earnings per share, which we have now calculated to be the 2.59. The 2.59 font group or numbers, make a couple decimals, and then font group and underline. That's going to give us our stock price. Stock price, which is going to be equal to the 30 times the 2.59, 78. Adding a couple decimals, though, in the number group, couple decimals, we're getting to the 77.59. So now let's think about a situation if we had the stockholder assets with the dividends versus if they were to give the dividend versus if they were to reacquire the shares. So if you're talking about an individual stockholder with an individual stock, where would they be if you had given the dividend? Well, we would have the stock price. The stock price we said was at the 75 on the stock price. And the dividend that went out was that we paid out 2.5 on the dividend. So that means they would have cash of the 2.5. Let's make another number group, couple decimals, cash for the 2.5 and the stock price 75. Underline that. Let's add decimals here too, just to make it consistent again. Consistency theme here. Value then is going to be equal to the sum of the 75 and the 2.5, adding a couple decimals, number group, and adding a couple decimals. So that's where one shareholder that owns one share would kind of stand after they had the share and the dividend of the 2.5 distributed, we are imagining here. And if we had reacquired, then what would happen? The dividend would not have gone out, but we would assume the stock price to increase to this 77.59. So not exactly a little bit of a different here, but point being that we would expect it to be somewhat similar given the situation, right? If you gave the dividend out, then you're going to have a situation where you got the stock price where the stock price is at, and then the dividend cash received by the stockholder. If the company was to purchase their own stocks back and everything else was equal, we would expect then the stock price to increase. And of course, they wouldn't get a dividend because we didn't use the cash in order to give out the dividend. We used the cash to reacquire the stock, therefore increasing the stock price in this case to the 77.59.